Well, 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 isn't that something how all of a sudden, a couple of days before the inflation report was set to be released, the expectations from the market were revised down from flat inflation month over month to all of a sudden expecting some sort of minor deflation to the tune of 1/10 of a percentage point, and that is exactly what the chefs cooked up for us this morning when they released the numbers at 8:30. In today's episode, we will be breaking down the market's reaction to the CPI report as well as the report itself, line by line in the second half of today's episode. So stay tuned for that. We've never done that on the channel before. Should be interesting. Let's kick things off here on the SPY daily time frame chart. Quick reminder before we get into the thick of it that a thumbs up on the video goes a long way to show some support for the channel. With that said, what do we see here from a price action, structural, and psychology perspective? Certainly a green-bodied hammer candle, so the lower wick represents buyers stepping up. Green body represents a close over the opening print. We looked into the prior day's range. The lower wick is here. We close above the prior day's range. That does strike me as bullish. In terms of location, 394.50 continues to act as support with another daily close above. Once again, the lower wick looked underneath the level, and we close back above as of the 4 p.m. cash close. Why is 394.50 such an important level? It continues to be important because of this overhead supply here. The more time we can spend above this area, the less likely it is that we see this play out as a bearish pattern, right? The head and shoulders ideally wanted to see a lower high underneath the overhead supply, so it would continue to act as downward pressure. It's no longer the case. The more time we spend above, the more meaningful it becomes. Doesn't mean that we're looking for all-time highs over the next couple of days, but it does start to reduce the probabilities of the bearish pattern playing out. Now, are we expecting just blatant continuation into the remainder of the week? I wouldn't be so quick to say so. We are expecting a little bit of a slowdown here at the daily 200 SMA, the upper edge of the weekly expected move, and the weekly resistance trendline is well within striking distance. Let's have a look at the hourly time frame chart and see what we can see here from a trend perspective, right? We've got lows, higher lows. You could count this lower wick from the first 30-minute pullback today as a higher low, but we never flipped into a meaningful hourly downtrend. Notice how these candles certainly produced bar-to-bar lower highs and lower lows as well. So on the flip side of the count, we've got highs, higher highs, and higher highs, basically meaning that we can afford some sort of higher low pullback. Now, where would that pullback take us? In a picture-perfect world, it's somewhere right here to the gap close from Wednesday's gap up, which is right around 390.50. It's about $1 north of the weekly level that we've been tracking for quite some time at 389.50. So let's not split hairs. Any kind of higher low in this general area, so here, flipping into an hourly meaningful pullback, finding a higher low is still constructive and bullish for the market, offering up a clean higher low here. Now, if the market gets here and starts to push lower, of course, that's a huge indication that would say, okay, the weekly downtrend remains in place. We are looking for a look above and fail, and the target would become the lower edge of the daily balance. Let's go there now. That would be here, right? So failing to hold this area as a higher low on the hourly or the daily, right? 50 SMA is there as well. Failing to hold this for a higher low, of course the seller should step back up, taking advantage of this daily lower high, weekly lower high, and push prices back into the balance, targeting this low down here. Now, I'm not convinced that that will be the case because we are seeing some meaningful developments in the sectors as well as the market internals. We'll talk about those momentarily. But for now, again, a new money long here, it's pretty difficult to get involved on a new higher high and trading close to the midpoint, or maybe the midpoint of this as an overhead balance, right? Here's the midpoint right around in here. So knowing all of that, what would be the consensus into Friday? Well, on Friday's session, we're not looking for the full-blown breakdown all the way to here, and we're not looking for the full-blown breakout over the weekly resistance trend line. We could look for the pullback that gets us here in the first place if we see a hammer candle develop tomorrow. Maybe it sets up a bullish Monday. Actually, is the market closed on Monday for a holiday? I believe it is. But regardless, some sort of hammer sets up a bullish next move over that high, possibly breaking the trend line in the future. Bull flag consolidation stays here if we're above 394.50. Those are the types of outcomes that we're concerned with for tomorrow's session. If we do get continuation, you are looking to possibly short for a pullback here off of this prior resistance at 402.50. That's what I would be concerned with on the SPY daily time frame chart as we move into the remainder of the week. Let's have a look at the market internals. There's something to learn here for everyone. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. The main takeaway is that the inflows continue to be really solid. CPI did not deter, buyers whatsoever. Really strong move, actually the strongest of the week, closing over 300 million, and the net read on the week's build is getting close to a billion, which is a significant read, right? It's at 943 million as of right now. Advanced decliners fall off of a cliff on the open, but then quickly recover and actually go on to close in the trend zone. That does strike me as a bullish improvement, recovering the closing print from the prior day session across the entire, or most of, I should say, the New York Stock Exchange. If we think about the tick as well, this has to be a bullish indication. Look at this on the Monday pullback, never goes negative. We talked about that yesterday. And then we're seeing sustained buying throughout the course of the day on all of the remaining sessions. It's not that we saw a quick morning covering session, short squeeze, and then some flat read in the cumulative into the remainder of the day. It's sustained buying pressure throughout the entirety of the day. And specifically, if we look at today's session, I want to talk about the liquidation break. Liquidation break took place here, right around 1:15. Selling came out of nowhere, right off of the highs. And what happened with the tick? Big negative impression. What happens? Quick recovery, 100% retracement. Any shorts who piled in here thinking, this is the moment, we're going to hell in a handbasket, absolutely rejected. They should have closed out of those positions, especially as we actually took out the high of day following. They should have had a stop somewhere up here if they were responsible day traders at least. If short-term sellers are out of the market, what does that leave to take over? The natural buying pressure of markets. So this also strikes me as a bullish data point. Let's move on over to our market profile. If you're not sure what this is, top right-hand corner's got you covered with another brief tutorial. In yesterday's episode, we were slightly cautious because the value area was left lower in the profile. Well, on today's session, it's, breakaway to the upside. Value is clean to the upside, and the point of control is also clean in the upward direction. We've got good, meaningful excess at the lows here, so the auction did end properly down towards the bottom. And we have a poor high, meaning that the auction did not end properly at the top. So knowing that we don't want to look for big new money longs here, but we do have a poor high, maybe the trade for tomorrow is looking for a quick repair of that high, and then coming back down into range for some consolidation. So carry this forward as a possible breakout level, but it's only going to be a scalp. I would not be looking for, again, like new all-time highs or retesting highs from 2022. That wouldn't be the case on the break of this area. We're looking at that as a scalp. Let's move on back to the platform here and quickly round up the sectors. I want to point out the percentage change on the week. Notice the bullish positioning here. Real estate's kind of an outlier, but other than that, we've got XLY, consumer discretionary, the tech sector, and communications in the top three positions. In the bottom three, and by the way, those are, of course, risk on. The bottom three positions, we have XLU, XLP, XLV, utilities, staples, and healthcare. Those are risk off. So we're seeing bullish posture in the sectors. We're seeing bullish buying pressure in the internals, and the structure here in the S&P itself is also supporting more of a bullish narrative. Again, we're just looking objectively at the data points. If this changes, if we fall underneath 389.50, we will reassess, but it's being supported across most of the data. Let's have a look at the structural charts themselves. Of course, the real estate sector breaking out over 39 strikes me as being positive for the wealth effect. And I do want to address a comment from a prior video. Someone pointed out that this is primarily comprised of REITs, and you're absolutely right, having much more to do with commercial real estate. However, we use this as a general proxy for median home values, real estate values as a whole. Therefore, if real estate values are moving back in the upward direction, it has a positive impact with the wealth effect, more discretionary spending from consumers. It's not a one-to-one direct ratio, but that's the general idea and why we use the XLRE. So great point on your part, and that would just be what I say. If you have a counter argument and you have evidence to prove that that's a wrong line of thinking, I would love to hear from you, and I would love to see links or something that could support that claim. And again, I'm not saying that you're trying to argue. Let me be clear about that as well. I'm just, I want to be accurate in our analysis here, so I appreciate you bringing up the data point. Let's talk about the XLY. What do we see in the consumer discretionary sector? Certainly big improvements here. Again, bears wanted to see a clean lower high off of the very bottom of the range here at 135 or off of the mid-range bottom at 137.50. It just wasn't the case. It's very hard to say that this is not a constructive and bullish look for the XLY. Something that would have been bearish would have been rejecting here for some sort of breakdown or here for some sort of breakdown. We're not saying that it can't happen, but as of right now, this is going against what the prevailing wind was in the bulls' favor. Let's have a look at the XLK. Another bullish improvement here, finally getting a daily bar to close inside of the prior overhead supply. Again, steps in the right direction. We're not out of the woods yet, but definitely has more of a bullish tone to it than bearish. Next up is the XLC for communications. Going to say very, very similar things across many of the risk-on sectors. Notice, straight shot from the bottom up to the top of the range. High opportunity for this to pull back, find any sort of higher low. A reattempt here, breaking out. That's got to be a bullish force for your S&P 500. Next up is the XLB for materials, really lightweight sector, less than 2.5%, I believe, as of right now, but right back up towards the highs. Again, if it was going to be bearish, it should have found a lower high underneath 80.75. Wasn't the case. Should have potentially run into resistance here for a lower high before this. It's not the case. On a weekly look, you could argue that you've got something that looks like this, and that's constructive for your S&P 500. So again, although it's not a heavyweight sector, it's certainly not providing any sort of headwind for our market. Same thing can be said about the XLI, but this, of course, is much closer to 8% of our S&P 500. The fact that this has clean lows, higher lows, higher lows, a little bit of a cup and handle pattern could potentially form up here. You could just look at it as a bull flag. It's bullish. It is not a headwind for the market. It's starting to turn into a tailwind, especially if it can break out over 103. Next up is the XLE for the energy sector. This is D for defensive. This is risk off, and it's playing semi-nicely in this overall range. It's getting a little bit more bullish than bearish here, but as we'll see in the ratio grid momentarily, it's actually not outperforming the market, so we're okay from that perspective. Next up is the XLF. This is a heavyweight risk-on sector, and it too is hanging out right back up towards these highs. Much more of a V-shaped recovery here instead of a cup and handle type look, but nonetheless a clear opportunity for a higher low pullback from this perspective here. Anything that now pulls back and remains over 34.50, hard to argue that it's a bearish look in the XLF. So again, it's not so much that we're expecting all-time highs. What we're pointing out to you in these videos is the improvement in the conditions so far across the S&P as a whole. XLU for utilities, D for defensive. It was the actually, not the only red name on the board today, but certainly more red and the other ones that we've seen here, coming in right back to the breakout level. And again, even though it did break out, it's certainly not outperforming the market by any stretch of the imagination. This is exactly what we want to see from a risk-off sector. Next up is the XLP, which is also a risk-off sector, and it too is playing nicely. Notice that this is a balance area. This is a balance area. We've been talking about this as a combined balance. It's possibly threatening a break of the bottom. Now, a breakdown here would be okay because this is a risk-off sector, but as we always say, bear in mind that, downward pressure is still downward pressure for the S&P, but it's okay that it's happening in more of a risk-off sector as long as we see, quote-unquote, the baton being passed to things like still continued outperformance in the XLK, XLY, and the XLC. Next up is the XLV for the healthcare sector, which is technically D for defensive, but as we know, it's the second heaviest weighted sector for the S&P. The fact that it's going sideways in this box strikes me as okay. It would be more ideal if this could start to inch up and get closer to a breakout there because it is the heaviest weighted sector. But again, if any of the heavyweight sectors are going to lag, we want it to be the XLV because it does represent defensive posture. Let's have a look at our ratio grid now over on this screen here. If you don't know what this one is, top right-hand corner's got you covered with yet again another tutorial. Top 4 sectors are the risk-on sectors. Again, we're not saying that this is going to all-time highs, but note the clear improvements that have been made in the XLK. So not out of the woods yet. We're not in an uptrend here. We're not taking out these highs yet, but there are some improvements, which helps the bullish narrative. We're not risk on yet, but improvements. That should be the title of today's video. Improvements, right? XLV. Falling off, but as we just noted, this is the heavier weight risk sector that we want to see coming in because it's D for defensive. XLF is possibly going to put in a higher low over the 50 SMA, which is upsloping. It's in an uptrend that is risk on. And the XLY is doing an impressive sort of counter trend rally here, but it's still a counter trend rally until proven otherwise. Once again, boils back down to that I word, improving, not necessarily justified for a full-blown risk-on look. Next up are the bottom 4 sectors, which are the risk-off sectors. XLP falling off of a cliff, utilities coming in, even though we got that daily breakout, energy is going sideways, and real estate for the most part is sideways with a slight bit of lift here. So risk-off is slowly phasing out, but we do need to see improvements here, and we would like to see some sort of improvement here and a more meaningful higher low produced in the XLY. Speaking of the XLP, I want to continue to remind you of this weekly look. Resistance trend line is coming in and doing as it should, producing a little bit of a pullback here, which has typically coincided with market bottoms. It doesn't mean that, again, we're going to all-time highs, but conditions improving. Let's have a look at the XLY over the XLP. Yet again, I'm quite excited to be talking about this one 2 days in a row with two back-to-back big updates to bring you. Growth versus value. Last time we discussed the break of the trend line. Today, we're discussing the close over the 50 SMA. Once again, it speaks to the I word, improvements in the bullish direction. Could this turn into a fake move that looks like this and then we collapse? Absolutely. But it could also turn into a move that looks like this, much more healthy for the S&P 500. So, going to continue to monitor this. The odds of it becoming a counter trend move now are reducing, and the fact that it could become a new trend in itself is improving. Okay, so a bullish data point for our S&P 500. Let's go ahead and have a look at our dollar now. Dollar is coming in more aggressively underneath that 105. Remember that this does have inflationary sort of impacts on the economy, on the market as a whole. So I wouldn't be surprised, based on today's CPI coming in a little bit, on expectation, but certainly deflationary in the month-over-month read. I wouldn't be surprised if Powell and the gang comes out and starts to try to talk markets down from this rally that it's been seeing here. They don't want financial conditions to loosen too much. Otherwise, we get back into that sort of euphoric spiral out of control when it comes to inflation. And we'll be dissecting that report in just a moment. But quickly, taking a look at some rates, TNX is up first. Notice that we've got a sort of possible lower high into the breakdown of this area here. On today's session, if I zoom in, this is an inverted hammer, of course, indicating that there wasn't really, people who wanted rates higher. They didn't step up and do anything meaningful in the morning session. And as a matter of fact, we closed week looking for that breakdown would confirm a new weekly downtrend, potentially alleviating some of the pressure in the XLK, the tech sector, which of course would drive the S&P higher in theory, right? So the fact that the TNX is threatening this breakdown does strike me as being more bullish than bearish. Having a look at the Fed Watch tool, what we'll notice over here is that we are continuing, even after the CPI report, to call the terminal rate at 500 basis points, 5%, rate cut in November, rate cut in December. Going back on over to the platform here, what does the TLT have to say about that? Having a look at the TLT, the main purpose of looking at this chart over the past couple of days has been to gauge whether or not there's outperformance, whether or not people are feeling fear in equities and rushing into bonds to see if they can get more of a safe haven type return. And that's not the case. If it were, the blue line would be shooting, dramatically higher in the upward direction. And you can see clear as day that there is no flight to safety going on here by any stretch of the imagination. Let's go ahead and have a look now at some volatility products. That's really going to wrap up our S&P. Then I want to dive into the nuance of the report with you. So don't go anywhere just yet. We're going to dive into that CPI report. Here we go. Volatility breaking down aggressively underneath 2050. Pretty hard to say that that's not bullish. This has been a floor that's been really, really troublesome for the volatility market for quite a while, right? If we go back, we remember that this prior ceiling in here then turned into a floor throughout 2022 when the market has been in this big downtrend. This is a clear change in tone. We have seen some moves underneath 2050 here and here, but this, if this can sustain and get more price acceptance down below, again, all of this data lends itself to a possible paradigm shift from 2022 headed into 2023. Wouldn't that be something if all of a sudden the calendar flips and now we're in a new bull market? Again, the data is improving. We're not all the way there yet, but the odds of this improvement continuing do look good so far based on what the VIX is telling us. The VVIX itself, the volatility of the volatility index, is perked up a little bit, but I would expect this to just kind of stay flat down here. Remember that this opens us up to the complacency effect, but as of right now, nothing about this, right? There's no major divergence with a move like up to here as the VIX is breaking down, not by any stretch of the imagination. Let's have a look lastly at the VVIX, the volatility futures plummeted, right? Big move down, no worries about backwardation here. That should be expected with the VIX doing what it did on today's session. All right, here we go. Here comes the fun part. CPI. Here it is. What I want to point out on today's session is primarily the divergences and things that you need to continue to pay attention to. Here's the month-over-month read. Came in deflation to the tune of 0.1%. You might be saying, oh, that's fantastic. Well, at first glance, maybe, but let's look at all the categories because it's not so obvious at first glance that, the inflation where it matters is really coming in. Food, up 0.3%. No deflation in food, down slightly from the October-November difference by the tune of 0.2 of a percentage point. So moving in the right direction. However, still inflationary for the people. Again, food is one of the biggest inflation drivers because that's what everybody needs, right? That should go without saying. Anyways, energy, another thing that was marked as being hugely deflationary to the tune of 4.5%, but notice where it's coming from. It's coming from these segments right here. If we go across, it's the energy commodities. Sure, gas is down. Fuel oil is down. I don't know too many people anymore who use fuel oil to heat their homes. Motor fuel is down. But if we look at what really matters, energy services, electricity, and utilities, as in piped gas for your stove, it was still up. Now, granted, it's not big reads in the upward direction, although actually utilities here, piped gas was, but 1.5, not the end of the world. 1, not the end of the world, but still inflationary nonetheless when we're preceding a trend that was, deflationary over the November reads, right? So we're making some improvements, but this is not what the consumer feels. This is not really helping the people out at home, right? If we continue down, what else do we see as a big driver for deflation? Here we go, negative 2.5%, used cars and trucks. How many people do you know go out and buy a new used car every year, right? Usually, I looked up the stat, so I wouldn't be misspeaking here, speaking out of line. It's a 5-year thing. Right now, granted, there's going to be some turnover people who bought 5 years ago who now it's time to get a new car, but it's not everybody. So the fact that used cars are coming in, it's helpful, but it's not like everybody is always looking for a new or used car. So to me, that's not really a huge improvement. Let's see what else we have that's a pretty sticky one. It's going to be your shelter, all right, right here. Again, it's not crazy high. It's not, some 2, 3, 4% read, but the fact that this is continuing to be inflationary, big driver, right? And that's both in rent of primary residence and owner's equivalent rent. So as we've pointed out, well, actually, let's finish up the report and then I'll tie it all together here for you. In terms of services, right? Hospital services up 1.7%. No deflation happening there. In terms of motor vehicle repair, still inflationary, 1% in the upward direction. Airline fares coming in a little bit, but again, airfare, I get it. Some people travel very, very frequently for business, and that's a whole industry in of itself. But again, maybe I'm not hanging out with the right people, but I don't know folks who are just jumping on planes every weekend to go on a vacation, and they're constantly spending on airfare. So I don't believe that this truly has a big impact on your everyday consumer. So to tie it all together, if you remember from the financial outlook report that we published just a couple of weeks ago, something that we were concerned with it was threefold, right? So this is not so much about prices of equities being so high, but services inflation is still untamed, meaning that it's still high. And that's exactly what we just saw with the healthcare services, with the motor vehicle repair services. They're still reading hot. Although we printed a month-over-month deflationary read, services inflation is still untamed. And if we scroll down a little bit, one of the things we noted was that consumers were spending and saving less, or their intentions were to spend less. Well, of course, if used vehicles are coming in a little bit, then they're going to say, maybe I'll wait. I'll wait on that purchase, wait for prices to come down a little bit. If they're not spending, again, what does that do to sales for all of these companies? So overall, you can go on and read through this entire report. I think the CPI data continues to really show that this will be an issue for 2023 as services, as we just saw in the report. Again, this just goes without saying. I don't know why I'm continuing to reinforce the same idea. It's not under control yet. We're seeing some improvements, but not really in the areas that we need to see the improvements in, right? So steps in the right direction, much more of a fundamental take. This has nothing to do with what you should do for tomorrow's trading session. This is just some fundamental commentary that I wanted to include towards the end of today's video. Let me know down below in the comment section if you enjoyed it. If you're like Matt, stick to the technicals. You have no idea what you're talking about as a fundamentalist. That's a-okay with me as well. I am not by any means an economist. I am not a licensed professional in the financial industry. So if I should stay in my lane and stick to the technicals, you can let me know down below in the comment section as well. And my feelings will absolutely not be hurt. With that said, folks, I wish everybody a great trading Friday. We'll be live tomorrow morning at 8:30 per usual. And if you don't tune in, that's a-okay. Have a great weekend. Stay green in the markets, and we'll catch you in the Sunday weekly watch list video.